Welcome viewers to this video. Today I'm going to be looking at one of the topics in financial management under CPA. It is called Introduction to Portfolio Analysis. So let us start by defining what is portfolio. So this is how we can define a portfolio. We say a portfolio is a collection of different investments held by an investor. So the key word there is different investments. That is because if a person invests in a single project only, that cannot be called a portfolio. A portfolio requires two or more separate investment projects. If you buy shares in one company only and you don't have any other investment in any other company, so we cannot call that one a portfolio. But if you buy shares in company A, you buy other shares in company B, you buy other shares in company C. So in one word, we can say that is a portfolio, a collection of different investments. So a portfolio can include shares or bonds or treasury bills. It can be in real estate, among other investments. So any investment in the money markets, any investment in the stock exchange market, all those, if you have several of them, then we say that you have a portfolio. So these are the goals of creating a portfolio. The reason you invest, one is because you want to generate revenue, but the reason you invest in many companies at the same time is because you want to minimize risk. So that is one of the goals of creating a portfolio, to minimize risk. Loss from one investment is offset by profit from another investment. So if you buy shares in company A and maybe company A makes losses, then it means you are going to suffer those losses. But if you buy shares in company A and then you buy other shares in company B, it is very unlikely that the two companies will be suffering losses at the same time. So you can lose income from one company, but you can get income from the other company. So that is what it means to minimize risk. You're not going to lose too much. The other goal is, of course, to maximize return or income. The more investments one has, the higher the expected income. So those are the two goals of creating a portfolio. So let us next define risk. So risk refers to the possibility that the actual return on an investment will be different from the expected return. You are expecting to get 20% return from an investment, but instead of getting 20, you get 15% or you get 10%. So that uncertainty is what creates risk. So in other words, we can say that risk is the uncertainty about future outcomes. You are not sure, so somebody will tell you, if you invest in this company, you're going to make 20% of the investment every year. But there is no guarantee that you're going to be making 20%. So other times you'll make more, other times you'll make less. So because there is no guarantee, we say there is risk. In finance, risk is measured by the variance or standard deviation of returns. So variance is the difference between what you are expecting and the actual results. Those differences or those uncertainties are the ones we call variance. So the unit we use to measure risk in finance is called standard deviation. We are going to talk more about this one later. So next we have risk-return trade-off. So risk-return trade-off means you can either decide to minimize risk or to maximize return, but it is very unlikely that you can achieve the two at the same time. So remember the two goals we have seen in the first slide. One is to minimize the risk, the other one is to maximize the returns. In most cases, you cannot achieve those two at once. So this is the reason. The higher the risk, the higher the expected return. So that is usually what happens in investment. The only reason you would invest in a risky project is because that project promises to give you a lot of money in the future. If the project has a high risk and it has a low return, you have no reason of investing in that project. And then the opposite is true, that the lower the risk, the lower the expected return. So investors must choose whether to maximize returns and accept higher risks, or minimize risk and accept lower returns. So you have to choose one. It is unlikely for you to achieve the two within the same project. You either decide you want to minimize the risk, or you decide you want to maximize returns. So that is why we call it risk return trade-off. You are trading one, you are giving up one in order to get the other. So we have three types of investors here. We have risk-averse investors. They want to minimize risk. They select projects with low risks, even if it means low income. So a risk-averse investor selects projects that have the lowest risk. They choose to minimize risk, even though that means they may get less income. Next, we have risk-seeking investors. They want to maximize income, so they select projects with high returns regardless of the risk. So a risk-seeking investor is always attracted by projects with the highest income. So most of them are people who have a lot of money, the rich people, because they have a lot of investments in other places. So they are not worried about losing money in one project. But for people who have less money, they are afraid of losing that money. So most of them tend to become risk-averse investors. And then we have a person who is in between the two, in between the risk-averse and risk-seeker. We have a risk-neutral investor. So risk-neutral investors, they balance risk and return. They select projects with moderate risk and return. So next we have types of risks. So on the left side, we have systematic risk, also known as market risk. And then on the right side, we have unsystematic risk, also known as specific risk. So we want to see the differences between these two types of risks. So first, if you are asked to define each of these risks, how do you define a systematic risk? You can simply say, this is a risk that affects all companies or all industries. In other words, a risk that affects the entire economy. It is not specific. It does not affect only one type of industry and leaves the other. For example, it will not affect the agricultural industry and leave the manufacturing industry. Instead, it will affect all of them equally. So that is how we can define systematic risk. And then on the other hand, unsystematic risk can be defined as a risk that affects specific companies or industries. For example, this risk can affect agricultural industries, but not manufacturing industries. So we can call it a specific risk or unsystematic risk. Or it can affect a specific company. Even within a large industry, it may affect only one company or a few companies. So this one does not affect the entire economy. Then back to the systematic risk. So systematic risk cannot be eliminated through diversification. So the reason we say you cannot eliminate it is when you look at the examples given below. Examples of systematic risk are risks such as inflation, interest rate changes, and recession. So for instance, we say there is inflation in a country. So that inflation affects all industries. So maybe it is caused by something like a civil war. When a country is at war, all the industries within that country are going to be affected, and they're going to be affected equally. So what can you do to eliminate the risk? So you can do other things, but you cannot diversify. If you diversify, still you cannot be able to eliminate that kind of risk. But for the unsystematic risk, it can be reduced or eliminated through diversification. So look at the examples we have here: company mismanagement, strikes, product failure. So this risk can be eliminated. For example, if it is product failure, maybe through proper research and development, you can be able to eliminate that risk. Or if one product is failing because of market trends, you can invest in a different kind of industry where the products are performing well. So through diversification, you can be able to eliminate unsystematic risk. So below we have risk-free versus risky assets. So on one side we have risk-free assets. On the other side we have risky assets. So what is a risk-free asset? This is an asset whose returns are known with certainty. You are guaranteed, or you are sure you are going to get a certain amount of money at a certain time in future. So there is no uncertainty. Therefore, there is no risk. So remember we said that uncertainty is what causes risk. So if the uncertainty is not there, it means there is no risk. On the other side, risky asset, this is an asset whose future returns are uncertain. They are not guaranteed. Sometimes you can get a high income, sometimes you can get a low income, other times you can even make a loss. So for the risk-free assets, we say there is zero risk and zero standard deviation. So standard deviation is the unit we use to measure risk. And when the value of standard deviation is zero, it means that the risk is zero. But for the risky asset, the risk is higher than zero, and so is the standard deviation. So when you calculate the standard deviation of a risky asset, you will not get zero. You will get a number that is higher than zero, which means that the risk is there. So examples of risk-free assets, these are investments in government, treasury bills, or bonds. So it is only the government that is capable of guaranteeing you the income in future, because companies cannot be able to guarantee, because they depend on the market trends. The government is very stable. Most of the governments are quite stable. So if you buy investments, if you buy treasury bills in the government, you are guaranteed that what they told you they will give you is what they are going to give you. But for the risky assets, examples include shares, corporate bonds, real estate. So corporate bonds, these are bonds issued by companies, and companies can collapse, companies can become bankrupt. So there is no guarantee that what they told you they will give you, that they will actually give you in future. So for the risk-free assets, we have an example here. If a treasury bill promises 10%, you are guaranteed to get 10% at maturity. And so we compare this with lending money to your most trusted friend. So this is a person who has a good history. Whenever you lend them money, they always pay back. So in other words, we say there is no risk in lending money to that person. But on the other hand, for the risky assets, if you invest money in a business, the business may give a profit or a loss. Income is not guaranteed. It is like lending money to a person who has a history of not paying back. So if you have lent money to one of your friends, then you have to follow up for them to pay. Sometimes they don't even pay. So the next time the person comes to borrow money from you, you might deny them the money. You might tell them you don't have. And if you decide to lend them, you will lend them knowing that there is a 50% chances that you are going to get that money back. So you'll understand that you are doing something risky by lending them. So in a risky asset, it is the same thing. You are never guaranteed that you're going to get the return from your investment. So those are the types of risks, and that is the meaning of the risk-free assets and the risky assets. So next, you want to know how to calculate expected return of a portfolio. So the expected return of a portfolio is the average return an investor anticipates from all the assets combined in the portfolio. If you invest in one asset and you get 10% return, and then you invest in another asset and you get 15% return, what is the average return of those two assets? That is what we call the portfolio return. It is an average calculated from many investments, each investment having a different rate of return. So it is the weighted average of the expected returns of the individual assets. The weights are the proportions of total money invested in each asset. So here is a simple illustration to help you understand what we mean by weights and how we calculate the expected returns. Suppose an investor has 100,000 to invest. Then the investor decides to invest 60,000 in company X and 40,000 in company Y. The expected return from company X is 12%, while that of company Y is 6%. So what is the expected portfolio return? So from our explanations, we have said it is the weighted average. It is the weighted average. And we have said that the weights are the proportions of total money invested in each asset. So what is the proportion of investment in company X? You take the amount invested in company X, you divide by the total amount invested in all companies. So in company X, the weight of X, WX, is the amount invested in company X divided by the total amount of money invested in both companies. So the weight of X is the proportion of X, which is 0.6. Similarly, the weight of Y, you take the amount invested in Y, 40,000, you divide by the total amount invested in both companies, 100,000. So the weight of Y is 0.4. So that is the first step. For you to find the expected return, find the proportion of each or the weight of each investment. So once you have that, now you can multiply with the returns. Multiply with the returns of each company. The weight of X multiply with the return of X. The weight of Y multiply with the return of Y. And then you add them together. So multiply the weight of each company with the expected return of that company and add the two answers. So the return of X is 12%. Multiply it with the weight of X, 0.6. So 0.6 times 12%. Take the return of Y, 6%. Multiply it by the weight of Y, 0.4. So 0.4 times 6%. So when you multiply, you will get these figures. For X, it will give you 7.2. For Y, it will give you 2.4. Then you add 7.2 plus 2.4, you'll get 9.6%. So this 9.6% is the expected return of the portfolio, and it usually falls between the two assets, the two investments. So the 9.6% is between 12 and 6. It can never go below the lowest you are given, which is 6. It can never be beyond the highest you are given, which is 12%. So that is how we calculate the expected return of a portfolio. So next, we have something called a standard deviation. We have seen this one before, but how do we define standard deviation? In simple words, we say that standard deviation is the unit used to measure risk, is a measure of risk. In finance, standard deviation is the most common unit that is used to measure risk. It shows how much the actual returns of an investment move away, that is deviate, from the expected return, that is the average return. In other words, it tells us how spread out or unstable the returns are. So this is how we interpret standard deviation. Mostly when we have two investments, we normally compare the two investments. So if one of them has a smaller value, there is what it means. If the other one has a larger value, there is what it means. So small standard deviation means that returns are close to the average. So there is less variance, there is less instability, which means the investment is stable or less risky. And then large standard deviation means returns vary a lot from the average. It means there is a high variance or high uncertainty, which means the investment is more risky. So if you are given two projects, one has a small standard deviation, one has a large standard deviation, we always select the one that has a small standard deviation because it is less risky. So this is the formula that we use to calculate standard deviation in finance, in portfolio. So standard deviation is equals to summation of this. So focus on the brackets. So let us start with the brackets at the center. RJ minus ER. RJ stands for return in state J. Return, that is what you expect to get under a specific state. So state can be the economic state. For example, it can be boom, it can be normal, it can be recession. So there is what you expect to get if the economy is at boom. And that is not the same as what you expect to get when the economy is at recession. Alright, so RJ is what you expect to get at a specific state of the economy. Minus ER equals to expected return or average return. So you have a return for boom, you have a return for normal, you have a return for recession, and these three returns are not equal, but you can find an average out of the three. So that average is the one we use here. So take the return in state J, deduct the expected return, which is the average. This will give you variance. Inside these brackets, you are going to get variance. So once you have this variance, you are supposed to square the variance, and then you multiply by the probability of the state. For example, what is the probability that the economy will be at boom or at recession? So multiply by that probability here. So it does not matter which one you do first. Once you have the variance, you can multiply it with the probability and then you square. Or you can square the variance first and then you multiply it with the probability. So whichever way you use, you are still going to get the same answer. So, and then we have these larger brackets here, which means you're going to do this one for each state of the economy. You do this one for boom, you do this one for normal, you do this one for recession. You take the three answers, you sum them up, you add them up. So this is the summation sign. So you add them up and then you find the square root of that sum. That will give you standard deviation. You're going to apply this one in an actual question so that you can be able to understand further. So how to calculate the standard deviation? So this time we have a question, we have an illustration. It says the returns from security A can vary depending on the state of the economy as follows. So you are given economic state, recession. The probabilities are here. So recession and its probability, normal and its probability, boom and its probability. Then we have the percentage return. At recession, you expect to get 5%. Normal, you expect to get 10%. Boom, you expect to get 15%. So calculate the expected return for security A. Calculate the standard deviation for security A. So this is the solution. So expected return is calculated as follows. You go to recession. Take the return of recession multiplied by the probability of recession. So 5% multiplied by 0.2. That is what we have done here. Go to normal, the next state. Take the return for normal multiplied by the probability of normal. So 10% times 0.5. 10% times 0.5. You go to boom. Take the return of boom, multiply by the probability of boom. So 15% times 0.3. 15% times 0.3. So once you have multiplied each, you add. Once you have multiplied for recession and for normal and for boom, add them up. So for recession, you get 1%. For boom, 10% times 0.5, you get 5%. That is for normal. For normal, 10%, you multiply by 0.5, you get 5%. Then for boom, 15%, you multiply by 0.3, you get 4.5%. So when you sum them up, you get 10.5%. So this 10.5% is the expected return for security A. So next, we want to calculate the standard deviation for security A. So we have a table here showing how standard deviation is calculated. So the first thing, calculate variance. So what is variance? Variance is what you are getting under each state of the economy minus the expected return which we have already calculated, 10.5%. So what is the variance for recession? Take the return for recession, deduct the expected return, 10.5. So recession has 5%. So 5% minus 10.5% gives us negative 5.5%. So do the same for normal and for boom. Take the return for normal, deduct the expected return, it will give you negative 0.5%. And for boom, 15% minus 10.5%, it will give you 4.5%. So these are the variances. So once you have the variances, square them. So the next column we have variance squared. So some of them were negatives, but once you square them, they are going to be positives because it is a negative times a negative. It will give you a positive. So these are the results for variance squared. After you have squared them, multiply by the probabilities of the state of the economy. For recession, the probability is 0.2. So you multiply by 30.25, it gives you 6.05. For normal, the probability is 0.5 and the variance squared is 0.25. So 0.5 you multiply by 0.25, it will give you 0.125. Then for boom, the probability is 0.3. So 0.3 you multiply by variance squared, 20.25, it gives you 6.075. So add them up. add them up. Probability multiplied by variance squared, you find the sum of them, they will give you 12.225. So next, find the square root of that sum. Square root of 12.225, they will give you a standard deviation of 3.5%. So that is how we calculate standard deviation. That is the process that we normally follow. So next, we have something known as coefficient of variation, in short CV. So what is a CV? What is a coefficient of variation? The coefficient of variation is a measure of relative risk. So what do we mean by relative risk? Relative risk means we are comparing risk and return. We are comparing risk with something else, not just the risk alone, but we are comparing it with something else. That is what we mean by relative risk. So the CV, the coefficient of variation, compares the amount of risk as measured by standard deviation to the expected return of an investment. In simple terms, it shows how much risk you take for each unit of return you expect. So this is a formula for CV. It is very easy to calculate the coefficient of variation. You take the standard deviation, you divide by the expected return. Standard deviation, you divide by expected return. That is how we find the coefficient of variation. So how do we interpret the answer? A lower CV means better investment or less risk per unit of return. A higher CV means worst investment or more risk per unit of return. When deciding which security to invest in, always select the one with the lowest CV. Why? Because as we have said, lower CV means better investment. It means less risk. So according to our formula here for CV, what will happen if the numerator is increased? If the numerator, here the numerator is the standard deviation, if you increase the numerator, the value of CV will also increase. So which means the numerator is the one we use to measure the risk. Which means a higher CV means a higher risk compared to return. So what will happen when you decrease the numerator? When you decrease the numerator, the value of CV will be less. And when it is less, it means it has become less because you have reduced the risk. That is why we are saying a lower CV means less risk. A lower numerator leads to a lower coefficient of variation. So we have an illustration here. So from the earlier question, we had expected return of 10.5%. We had a standard deviation of 3.5%. So calculate CV from this. It is very easy. According to the formula, just take the standard deviation, you divide by the expected return. The standard deviation is 3.5%. Divide that by the expected return of 10.5%. That will give you 0.33%. So how do we interpret 0.33%? This means security A has 0.33% risk per 1% of the expected return. So whenever you are dividing these two, or whenever you are dividing anything, the answer you get can be interpreted as a ratio. The answer you get represents the numerator. The answer you get represents the numerator. And the denominator takes 1. The denominator takes 1. So our answer of 0.33 represents the risk. It represents the risk. And the denominator will always be given a 1. So here it simply means that the risk is 0.33 for a return of 1%. So you are taking a risk of 0.33 in order for you to get a 1% return. So you are going to understand it better in the next part. So we have coefficient of variation CV application. So this is just going to show you how we make decisions using CV, or how CV helps to make better decisions compared to when we just rely on the standard deviation and the expected return. So the illustration is saying an investor wants to decide whether to invest in security X or security Y. The following details are provided. So we have the expected return for X is 15%, for Y is 12%. We have the standard deviation for X is 5%, for Y is 3%. Required, advise the investor on which security to invest in. So first, how would you make the decision if you are not going to be using the coefficient of variation? Remember the two goals of investment or creating a portfolio. One, we always want to maximize returns. So if you are going to advise a person without using CV, you're going to advise them based on the one that maximizes the return. So just look at the expected return and you suggest the one with the highest. So X seems to be giving us a higher return. So therefore, if the decision is based on return, the investor would select the security with the highest return, that is security X. But we have the other goal. Some investors are risk averse. So they will always go for investment opportunities that minimize risk. So which project would you advise the investor to invest in based on the risk? So the standard deviation, we say that the higher the standard deviation, the higher the risk, and vice versa. So in this case, Y has a less standard deviation, which means it has a lower risk. So therefore, if the decision is based on risk, the investor would select the security with the lowest risk, that is security Y. But now there is a conflict, because if you base your decision on risk, you select Y. If you base your decision on returns, you select X. Since the two decisions differ, the best decision is based on coefficient of variation. So let us see which decision we can make using the coefficient of variation. So for security X, so first the formula for coefficient of variation is standard deviation, you divide by expected return. So for security X, the coefficient variation of X is given by the standard deviation of X. Standard deviation of X is 5%. You divide by the expected return. Expected return of X is 15%. So 5 divided by 15 will give us 0.33%. From the previous slide, we know how to interpret the answer. So this means there is a risk of 0.33% for every 1% return. So we go to security Y, we calculate the coefficient of variation of Y. So take the standard deviation of Y. Standard deviation of Y is 3%. Divide by the expected return of Y. The expected return of Y is 12%. So 3 you divide by 12, it will give you 0.24%. So the interpretation of this is there is a risk of 0.24% for every 1% return. So we said the denominator is always given 1 and the numerator is given the answer from your calculation. So now compare X and Y. In X, you are taking a higher risk to get the same return that you can get from Y at a lower risk. Both of them are giving you now the same return. You can get 1% return from X at a risk of 0.33%. Or you can get 1% return from Y at a risk of 0.24%. So which one would you select? Since the two are giving you the same return, select the one that has a lower risk. So you are going to select Y because security Y has less risk in relation to return. So our advice would be invest in security Y since it has the lowest coefficient of variation. So next we have something known as covariance. So what is covariance? Covariance measures the degree to which the returns of two assets move together. It tells us whether they move in the same direction, both go up, that is one direction, or both go down together. If they are going to increase, they increase together. If they are going to decrease, they decrease together. That is same direction. Or whether they move in opposite directions. That is when one goes up, the other goes down. Or whether they are unrelated. There is no pattern. The movement of one does not determine the movement of the other. They are independent. So that is what covariance helps us to know. This is the formula for covariance. Assuming we have two securities, A and B, covariance of the returns of A and the returns of B is given by the summation of Pj. Pj means probability of state J. And then we have two brackets. In the first bracket we have Raj. Raj is returns of A minus ERA. ERA means expected returns of A. In other words, this is variance of A. This is the return of A under state J minus the expected return of A, which is the average return of A. This is the variance of A under state J. The next one is the variance of B under state J. So we know now how to calculate the variances. So in short, covariance of A and B is probability of the state of nature multiplied by the variance of A multiplied by the variance of B. You do this for each state of nature. This is J. J could be boom. You do another one such as normal. You do this one for the next one, maybe recession. So after you have done for all the states of nature which are given, you sum them up. So once you sum them up, the answer you get is going to be covariance of the two assets. So this is how we interpret covariance. Positive covariance means returns move in the same direction. That is, if one increases, the other one also increases. Negative covariance means returns move in opposite directions. That is, if one increases, the other one decreases. Zero covariance means there is no relationship. That is, changes in one does not affect the other. So this is something you're supposed to note, that negative covariance is good for diversification because losses in one investment are offset by gains in the other. So negative covariance is the one you should go for if your goal is to diversify. And actually the one of the main purpose of creating a portfolio is to minimize risk. And for you to achieve that purpose, you want to go with negative covariance, not positive. So positive means If they all make losses, if the economy is bad, they are all going to make losses. You're going to get nothing because they are moving in one direction. So in one time, they can give you a lot of income because they are increasing at the same time. In the other time, they can give you a lot of losses because they are decreasing at the same time. But for the negative covariance, they cancel out. One increases, the other one decreases, they balance out, so they minimize the risk. So here is an illustration for covariance. Suppose the economy has two states. So you have the states here, good and bad. We have the probability for good is 0.5, for bad is 0.5. We have return on A. At the good state is 12%, at the bad state is 4%. We have the return on B. At the good state is 8%, at the bad state is 10%. So calculate covariance from the above. So this is the solution. So first, recall the formula that I have given you for covariance. This is the formula. Covariance for return A and return B is given by probability multiplied by variance of A multiplied by variance of B for each state of nature, and then you sum them up. That will give you covariance. So as you can see in the equation, we need to have the expected return. So ER represents expected return. So we are required to calculate the expected return of A and that of B before we can apply this formula. So first, let us calculate the expected return of A and the expected return of B. So that is very simple. For A, you just take the return of A under the good state, you multiply by the probability of the good state. That will be 12% times 0.5. So that is what we have done here. Go to the bad state, take the return of A, multiply by the probability of the bad state. That will be 4% multiplied by 0.5. So that is what we have done here. And then you add them up, they will give you 8%. So the expected return of A, which is the average, is 8%. And then we do the same for B. You go to the good state, take the return of B under the good state, multiply by the probability of the good state. That is 8% times 0.5. That is what we have here. Then go to the bad state, take the return of B in the bad state, multiply by the probability of the bad state. So 10% multiplied by 0.5 is what we have here. And then add the two, they will give you 9%. So 9% is the expected return of B, which is the weighted average. So once we have the expected returns for both A and B, now we can be able to calculate the variances. To do that, we have a table here. In this table, the first column is the state. This is the state of the economy, which is either good or bad. It is followed by the probability. So as you can see, we are following what the formula says. According to the formula, Pj is the probability of each state of nature. So the column for probability, we have written it Pj. So you show the probability of good state, the probability of bad state in that column. Then in the next column, you go to the formula. In the formula, we have said Raj minus ERA. Raj is the return of A under state J. So let's say J represents the good state. So what is the return of A under the good state? The return of A is 12%. So here we have 12%. ERA is the expected return of A, which we have calculated. We have seen it is 8%. So this will be 12% minus 8%. So 12% minus 8% is 4%. That is the variance of A under the good state. We also calculate the variance of A under the bad state. Remember, J can represent good, and then we change it to represent the next one. So this is the state of nature, which is either good or bad. So you go to the bad state, take the return of A is 4%, deduct the expected return, which is 8%. So the variance is negative 4%. So the last part of the formula is the same as the previous one, but now it applies to return of B. So you take the return of B under each state of nature, you deduct the expected return of B, which you have found to be 9%. So variance of B under the good state is 8% minus 9%. So 8 minus 9 will give us negative 1. Under the bad state, the variance for B will be 10% minus 9%. So 10 minus 9 will give us positive 1. So once you have all this, you are supposed to multiply probability, multiply by variance of A, multiply by variance of B. So in the good state, the variance of A, the probability first is 0.4. So we take 0.4, multiply by variance of A, which we have found to be 4%, and then multiply by the variance of B, which you have found to be negative 1%. So once you multiply them, you get negative 2. Then in the bad state, take the probability 0.5, multiply by the variance of A, negative 4%, multiply by the variance of B, 1%, they will give you negative 2. And then according to the formula, we are supposed to sum them up. So you have a big summation sign at the beginning. So we add the results in the good state, the results in the bad state. So the answer we get is negative 4. So keep in mind that if we had another state of nature, for example, between good and bad, maybe we could have average. We would have done the same thing here, and then we add them together. Also, if we had an additional return, for example, here we have A, and here we have B. So if we had C, which means we had 3, we would just have added it at the end here. So it would have been variance of A times variance of B times variance of C. But for now, this is what we have, and the answer is negative 4. So negative 4 is now the covariance. So how do we interpret the covariance? It means, first of all, note the sign. The sign is negative. If it is negative, it means assets A and B move in opposite directions. That is, if one increases, the other one decreases. You can even see that one in the question, because in the good state, return A was 12, return B was 8, and then when the state changes to bad, A is reducing, A is decreasing, but B is increasing. So when A is decreasing, B is increasing, which means they are moving in opposite direction. So that is why we have the answer as a negative. So this is good for diversification, because when one asset falls, the other tends to rise. So that is how we find covariance, and that is how we interpret the results. So now we can go to the next part, which is correlation coefficient. So first, let us see the meaning of correlation coefficient. The correlation coefficient shows both the direction and the strength of the relationship between two investments. It is a standardized form of variance that always lies between -1 and +1. So in the previous slide, where we have seen the covariance only gives us the direction. Are they increasing at the same time, or is one increasing while the other one is decreasing? So it only shows us the direction. But the correlation coefficient takes it a step further and shows us the strength of the relationship. How much does changes in A affect the changes in B? So it must fall between -1 and +1. So this is the formula. So this is the sign we use to represent correlation coefficient. It looks like a P, but it's not a P. So we use it to represent correlation coefficient. So when we say PAB, that is the correlation coefficient between asset A and B. So the formula is, at the top you have the covariance. So this is covariance of A and B. You divide by standard deviation of A multiplied by standard deviation of B. So that is the formula for correlation coefficient. And then once you have the answer, this is how we interpret those answers. If you get 1 and it is positive, it means the two assets are perfectly positively correlated. Therefore, there is no diversification benefit, because positive means they are moving in the same direction. They increase at the same time, they decrease at the same time. If you get your answer as 1 and it is a negative, it means the two assets are perfectly negatively correlated. And this means they give you maximum diversification benefit. When one is increasing, the other one is decreasing. Losses in one are cancelled by profits in the other, so you don't lose too much. And if the answer is 0, it means the two assets are uncorrelated. Some diversification benefit. 0 falls between -1 and +1. So if we say +1 gives you 0 diversification benefit and 1 gives you maximum diversification benefit, therefore 0 is in between the two. It means it gives you some diversification benefits. So this is an illustration. So assuming you are given covariance of returns of A and returns of B as -4. You are also given the standard deviation of A as 4%. You are also given the standard deviation of B as 1%. So because this is everything you need to find correlation coefficient, so how do you calculate the correlation coefficient? Once you have the formula, it is very easy. You just need to plug the values into the formula. So the formula is here. So the numerator is covariance of A and B. Covariance is given as -4. So you plug it in the formula. The denominators is the standard deviation of A multiplied by the standard deviation of B. We have 4 and 1. So 4 times 1. So -4 divided by 4 will give us -1. So once you have the answer, how do you interpret this answer? So go back to the explanations. So go back to the explanations where we have -1. We said they are perfectly negatively correlated. So therefore, that is how we interpret it. This is perfect negative correlation, which means when A goes up, B goes down by the same rate. If we combine them properly in a portfolio, we could eliminate risk completely. So that is how we find correlation coefficient, and that is how we interpret the results. So we go to the next part. So the next part is how we calculate the portfolio risk. So we have the mathematical model. So mathematical model gives us an exact answer of the risk. So remember, standard deviation helps us to find the risk of one asset, that is one investment. But when you talk of portfolio risk, we are calculating the standard deviation of all the assets combined. But in this case, in this level, we only need two assets. So the formula we are going to be looking at is for two assets only. So first, let us start by defining portfolio risk. So portfolio risk measures how much the actual returns of the portfolio may deviate from the expected return. Portfolio risk is not the same as the weighted average of individual assets risk. And this is because the risk of a portfolio can be reduced through diversification. It can even be eliminated, as we have seen previously. So this is the formula for calculating the portfolio risk. So this sign means portfolio risk, because the first one is the standard deviation sign, and then P here stands for the portfolio. So this is the portfolio risk. So it is given by the square root of WA squared. So WA is the weight of assets A, weight of asset A or security A, and then WB is the weight of asset B. So whenever we have WA, that is the weight of A, or whenever we have W, that is weight, weight of A and weight of B. And then we're also going to use the standard deviation of both A and B. So you multiply the weight of A by the standard deviation of A, and then you have to square the weight. You also have to square the standard deviation. You do the same for B, and then at the end you take 2, multiply by the weight of A, multiply by the weight of B, multiply by the standard deviation of A, times the standard deviation of B, times the correlation coefficient of AB. This is one of the equations you can use, but we have an alternative. So if you are given this and you are told to find covariance of AB, how can you do that? You just have to make covariance of AB the subject of this equation. Multiply both sides by the denominators. So when you multiply the right side by the denominator, it will cancel out. You'll be left with covariance of AB. Multiply the left side of the equation by the denominator. You are going to end up with something like this. Covariance of AB is equal to correlation coefficient of AB multiplied by the standard deviation of A multiplied by the standard deviation of B. So therefore, if you go to this part of the equation where we have the standard deviation of A times the standard deviation of B times the correlation coefficient of AB, all that part is in this equation here, So therefore, this part of the formula can be replaced with just covariance. So we can remove from where we have WB, we can remove everything on the right side and replace it with covariance, because covariance is the same as those items. So this gives us an alternative formula where we say that the standard deviation of the portfolio, the first part is the same, weight of A squared times standard deviation of A squared plus weight of B squared times standard deviation of B squared plus 2 times weight of A times weight of B times covariance of AB. So this formula is the same as this. It should give you the same answer. So which one should you use in a question? In my opinion, the one with the covariance is a bit easier, mostly because you cannot find correlation coefficient unless you have covariance. Look at the formula for correlation coefficient. You must have covariance for you to find correlation coefficient. If you already have the covariance, so why would you go to find the correlation coefficient only to use it in this formula, while you can just take that covariance and use it in this formula to find the standard deviation of the portfolio. So you can use any, but the last one appears to be a bit easier according to me. So that is how we calculate portfolio risk. Those are the equations we need. So we are going to test these two equations using an example to see whether they can give us the same answer. So we have an illustration here. So we are through with the theoretical parts. The remaining thing is just to do this illustration, to implement everything that we have learned in this lesson. So this illustration is saying the following information relates to returns of two assets under various states of the economy as follows. So we have the three states of economy: boom, normal, recession. We have the probability of each state of economy. We have the return on security X under each state of economy. And we have the returns of security Y under each state of the economy. So we are supposed to calculate the following. 1. Expected returns on security X and Y. The expected portfolio return, given that 20% was invested in security X and 80% in security Y. So the first one is the return for each. Expected return for X, which is separate from that of Y. But the second one is now the portfolio return, which combines the two into one. Number 3, standard deviation of returns on security X and security Y. Number 4, calculate covariance of returns of security X and Y. Number 5, calculate the correlation coefficient. Number 6, determine the portfolio risk as measured by standard deviation. So we are going to conclude with this question, and it is going to help us now to summarize everything, to see how we are supposed now to calculate everything from one question. So let us start with the first requirement. The first requirement, we are required to calculate the expected returns on security X and Y, and this is the easiest. This is the easiest part of the question. The first two are the easiest because expected return is just the weighted average. Because here is for X alone and for Y alone, you just take the boom. For the boom, take the probability of boom, multiply by the return of X in the boom state. So 0.4 times 18%. Go to the next one, normal. Take the probability of normal, multiply by the return of X under the normal state. So 0.5 times 14%. 0.5 times 14%. Go to recession. Take the probability of recession, multiply by the return of X under recession. 0.1 times 12%. 0.1 times 12%. And then after you have multiplied for each state, you add the answers. So the answer you get for boom, which is 7.2, add it to the answer you get for normal, which is 7%, add it to the answer you get for recession, which is 1.2%. So the expected return for X will be 15.4%. You are going to do the same thing for return Y, for return on security Y, and for Y, it is going to give you 22.7%. So that was the first required part, the return of X and the return of Y, and it is very simple to calculate that one. The second required part was to calculate the expected portfolio return. So for the portfolio return, this one is also very easy. You just take the proportion of investment that was invested in X, that is called the weight of X. You multiply by the return of X. So take the weight of X, you multiply by the expected return of X. And the expected return of X is what we have calculated and found 15.4%. So weight of X times return of expected return of X. So remember in the question you are told 20% was invested in X, which means the weight of X is 0.2. So 0.2 times 15.4% will give us 3.08%. So do the same for Y. The weight of Y, in the question we were told 80% investment was made in Y. So that is 0.8. Multiply it by the expected return of Y, which we have calculated and found 22.7%. So once you multiply them, you will get 18.16%. So you add the answer you get for X to the answer you get for Y. So what you get here is 21.24%. And this is what we call the expected portfolio return. So let us proceed to the next required part. So the next required part, we were required to calculate the standard deviation of returns on security X and Y, but first we are going to begin with X alone, because this one is for individual investments. For the combined investment, that one is the portfolio risk, which you are going to do in the last part. So this is how we find the standard deviation of a security. The first thing, so this is what was given in the question. This table here is obtained from the question. So these are the workings. This is the table we created to show the workings. And we have already seen the expected return from the previous calculation. For X, it is 15.4%. So just make a table with these headings. Take the return of X under each state of the economy. Calculate the variance of X in each state of the economy. Variance, you just take the return, for example, if it is boom, take the return in the boom state, deduct the expected return of X, which is going to be constant throughout, so you get 2.6. Take the return under the normal state, 14%, deduct the expected return, 15.4, it will give you 1.4. Take the return of X under recession, 12%, deduct the expected return of X, 15.4, it will give you 3.4. So once you have these variances, square them. Find variance squared. So 2.6 squared will give you 6.76. 1.4 squared will give you 1.96. 3.4 squared will give you 11.56. Next, look for the probabilities. These ones are given in the question in this table. We have just transferred these probabilities the way they are and brought them here because we want to multiply the variance squared with the probability. So in the last column, that is what we are doing. We are taking the probability and multiplying it with variance squared. So 6.76 you multiply by 0.4, it will give you 2.704. Do the same for the next one and the next one. So once you have multiplied the probabilities with variance squared, find the sum of those. Find their total. So their total is going to be 4.84. So this 4.84 is the one we are going to find the square root in order for us to get the standard deviation of x. So this answer here, 4.87, is the one we are going to find the square root to find the answer. So the square root of 4.84 is 2.2. So that means the standard deviation of x is 2.2. So we are going to follow the exact same procedure to find the standard deviation of y. So in this page, we are calculating the standard deviation of returns of security y. The table is the same as the one we had for x, but for y, the expected return was 22.7%. We have taken the returns under each state of nature. So the returns for y are 24, 22, and 21. So those are the ones we have transferred to this part of the table. We have deducted the expected return, which is 22.7, to obtain the variances. We have squared the variances. Then we have obtained the probabilities, multiplied the probabilities with the variance squared, and that is what we have in the last column. The total for probability times variance squared is 1.21. Then once you find the square root of this, you get 1.1. Same procedure as x. So we are not going to look into many details because it is the same process. So the next part of the question, we were required to find covariance of returns of security x and y. So what is going to save you in case of a question is remembering the formula. So the first thing when you have a question like this, first try to recall the formula and then use it to do your calculations. So this is the formula for covariance. So covariance of x and y is given by probability times variance of x times variance of y, and then we sum them up. You do this one for each state of nature, and then we sum them up. So because we are required to have the expected returns for each, we have them here. Expected return for x from our previous calculations was 15.4%, and that of y was 22.7%. And then we put them in this table to do the workings. So for each state of nature, you are going to calculate the variance of x and a boom, variance of x and a normal, variance of x and a recession. This part here is the variance of x. Remember what we did with the previous calculations. We said that the variance, take the return for each state of the economy, deduct the expected return. The expected return for x is 15.4. So in each of these ones, we are deducting 15.4%. The variance for y, you are going to be deducting 22.7. You take the return under each state of the economy. For example, for boom, the return was 24. You deduct the expected return, which is going to be constant throughout. And then you're going to multiply by probability. So the answer you get here the variance of x, multiply it by the answer you get here, which is the variance of y, multiply it by the probability of boom, which was 0.4. So each one you multiply by the probabilities. For normal it was 0.5, for recession it was 0.1. So once you get the answers, in the last column we have the answers. According to the formula, there is a summation sign, meaning you have to add them up. So add them up, and the answer you get after adding is now the covariance of xy, which is 2.42. So once you know the formula, the workings are very easy to do. And because the formula may look complicated because it has a lot of letters in them, so just know that for the covariance, you take the variance of one asset, multiply by the variance of the other asset, multiply by the probability. You do this for each state of the economy, and then you add them up. So even if you forget this formula, just try to remember this one, because once you remember this, it is possible to do the calculations. So once we have the answer, maybe we want to know what it means. We want to interpret our answer. So first, the covariance of 2.42 is positive. So what does it mean? It means the two securities move in the same direction. So does the 2.42 have any significance? Besides being positive, does it have any meaning? So the answer is no, it does not have any significant meaning, because we cannot be able to say by what proportion does change in one affect change in the other. To be able to know that, we are going to calculate correlation coefficient. So according to the last point here, we are saying, however, we cannot determine the strength of the relationship until we calculate the correlation coefficient. So this 2.42 does not tell us how strong is the relationship between x and y. We only check if it is positive or negative. And then we say they move in the same direction or in the opposite direction. So now let us see what we are going to find once we calculate the correlation coefficient. So this is the workings for correlation coefficient. The most important thing, first try to recall the formula. So correlation coefficient, so this is supposed to be for xy, not AB. Correlation coefficient for xy is given by the covariance for x and y divided by standard deviation of x times standard deviation of y. We have already done all these calculations. We already have the covariance. In our last slide, we have seen the covariance is 2.42. We have already calculated the standard deviation of x. It was 2.2, and that of y was 1.1. So we have everything we need to find the correlation coefficient. So we just need to plug the values in the formula. So where we have the covariance of x and y, we are going to write 2.42. Where we have the standard deviation of x, we are going to write 2.2. And where we have the standard deviation of y, we are going to write 1.1. So if you do the calculations, 2.42 divided by 2.2 multiplied by 1.1. This will give you 1. So how do we interpret 1? This one is going to give us two answers, or there are two ways we can interpret it. The direction of movement and the strength of the relationship. So the answer is positive, meaning the two securities move in the same direction. And then the answer is 1. It is not 0.5, it is not 0.9, it is 1. Meaning the two securities are perfectly positively correlated. So what if the answer was not 1? Let's say it was 0.1 or 0.2. So if the answer is closer to 0, such as 0.1, 0.2, anything less than 0.5, it means the relationship is weak. If the answer is closer to 1 but not 1, for example 0.9, 0.8, anything higher than 0.5, it means the relationship is strong. So that is how we interpret our answers there. So next, let us go and calculate the portfolio risk. So the last part of the question, we were required to calculate portfolio risk as measured by standard deviation. So again, try to remember the formula. But in this example, I am going to use both equations because we said there is the first formula where we use the correlation coefficient. At the last part, we use the correlation coefficient. The alternative one, we said you can use the covariance. So I am going to be working with the two equations so that we can test them and see if they are going to give us the same answer. So this formula, it might look long, but it is not difficult because the first part, this is the weight of x squared, the standard deviation of x squared. First you multiply those. You can even add brackets here before you add the next one. The next one is the weight of y squared times the standard deviation of y squared. You can also add your own brackets here before you add to the next one. The next one is 2 times weight of x times weight of y times standard deviation of x times standard deviation of y times correlation coefficient of xy. So you can have 3 brackets. So you can have these ones in brackets, these ones in brackets, and these ones in brackets. From our previous calculations, we already know the weight of x, 20% or 0.2, the weight of y, 80% of 0 or 0.8, the standard deviation of x, 2.2, the standard deviation of y, 1.1, the correlation coefficient of x and y, 1. So you just need to plug them into the formula. We have weight of x 0.2 squared times standard deviation of x 2.2 squared plus, so first you do those workings in a bracket. The answer you get, you're going to add it to the next one. And these workings, once you multiply this, you're going to get 0.1936. The weight of y squared, 0.8 squared, times the standard deviation of y squared, 1.1 squared. Once you do the workings, they will give you 0.7744 plus 2 times the weight of x, 0.2, times the weight of y, 0.8, times the standard deviation of x, 2.2, times the standard deviation of y, 1.1, times the correlation coefficient of xy, 1. So once you do these multiplications, you will get 0.7744. Then once you add them up, you will get 1.7424. You find the square root of that, the answer will be 1.32. This is the answer we get using this formula. So let us try the next formula and see if we get the same answer. So this is the same thing we are trying to answer, portfolio risk as measured by standard deviation. But this time we want to use the covariance formula. The last part has changed. instead of having the standard deviation of each one multiplied by the correlation coefficient, we have removed all those and replaced them with covariance of x and y, which according to our previous calculations, it was 2.42. The first two parts will remain the same and will give us the same answers as what we had before. The only change is in the last part. So you take 2 times the weight of x, 2 times 0.2 times the weight of y, times the covariance of x, y. So once you multiply, they will give you 0.7744. Then once you add, they will give you 1.7424. Then once you find the square root, you will get 1.32. It is the same answer as what we had before. So you can use any formula because regardless of the one you use, you get the same answer. But this one, according to me, is a bit easier because it has fewer items. The other one requires you to use correlation coefficient, and for you to get that, you need to have the covariance of x, y. So this one has fewer steps compared to the previous one, and they both give you the same answer. So that is the end of the presentation. If you have a question, feel free to leave a comment. Thank you for watching. I'll see you in the next one. Bye for now.